Welcome to our CFP Exam Prep podcast. Today we're diving deep into retirement plan contribution limits, specifically focusing on defined contribution plans. Let's break down one of the most frequently tested concepts that trips up many candidates. The fundamental rule for defined contribution plans states that contributions are capped at the lesser of 100% of compensation or a specified dollar amount. This sounds straightforward, but understanding its application is crucial for the exam. For 2024, that dollar limit is $69,000, but remember that the exam might use different numbers, so focus on the concept rather than memorizing specific figures. Let's break this down with a practical example. Consider Sarah, who earns $50,000 annually. Her maximum contribution would be $50,000, not $69,000, because we must take the lesser of the two limits. Now think about Michael, who earns $150,000. His maximum contribution would be $69,000, not $150,000, again because we take the lesser amount. A common mistake candidates make is forgetting to include employer contributions when calculating these limits. The limit applies to the total of both employee and employer contributions. For instance, if an employer matches 5% of salary, this amount counts toward the overall limit. Another frequent error is confusing these limits with elective deferral limits, which are separate and smaller. Here's where it gets more complex. The compensation used for this calculation must be considered earned income. Investment income doesn't count. Many exam questions try to trick you by including various forms of income. Only earned compensation from personal services counts toward this limit. Let's explore another nuanced aspect. For self-employed individuals, the calculation becomes more complicated because they must reduce their compensation by the amount of their retirement plan contributions, creating a circular calculation. The exam loves to test this concept by presenting scenarios where candidates need to identify whether the contribution exceeds the allowable limit. A critical point often tested is the timing of contributions. These limits apply per plan year, not calendar year, and contributions typically must be made by the employer's tax filing deadline, including extensions. The exam might present scenarios where timing becomes a crucial factor in determining compliance. The most challenging questions often combine multiple concepts. They might present a scenario where you need to determine if a contribution is excessive while considering factors like catch-up contributions for those over 50, plan compensation limitations, and the interplay with other retirement plans. To master this topic for the exam, remember these key points. Always start by identifying the person's earned compensation. Compare this with the dollar limit. Consider all sources of contributions, not just employee deferrals. Watch for questions involving multiple plans or unusual forms of compensation. When you encounter these questions on the exam, take a methodical approach. First, verify the compensation is earned income. Then identify all sources of contributions. Finally, apply the lesser of rule. Don't rush to conclusions, as the exam often includes irrelevant information to test your ability to focus on what matters. Understanding these limits isn't just about passing the exam. It's fundamental knowledge for practicing financial planners who need to help clients maximize their retirement savings while staying within IRS guidelines. Remember, these limits protect the tax advantage status of retirement plans and ensure they're used as intended for retirement savings rather than tax avoidance.